Welcome back to Investing Talk Podcast.
Today we're looking at Rocket Lab.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Rocket Lab is in what I think you can only really call a hyper-growth phase right now. We're finally seeing all that heavy investment start to pay off in the financials, especially for 2025.
It's a huge pivot. If you look at the recent numbers, specifically Q3 2025, the company pulled in a really robust $155 million in revenue.
That's a 48% increase over last year, which is, that's a massive jump, and it beat estimates pretty handily.
It did. But what's really telling is that this trend is accelerating. They aren't just, sitting back.
Right.
The forward guidance is incredibly strong. For Q4 2025, they're projecting revenue to land somewhere between $170 and $180 million.
And that sequential jump quarter over quarter, that's the signal, isn't it? It tells you the launch cadence is up and that the space systems part of the business is scaling fast.
Exactly. This is the moment where the infrastructure they've spent years building finally starts to generate a real return.
And this is where the story gets really interesting for investors, I think. The margins.
The margins are seeing dramatic improvement. They hit a record 37% on a GAAP basis in Q3.
37%. And just to be clear, GAAP generally accepted accounting principles. That's the standard conservative way of reporting. So this isn't some kind of accounting trick.
No, not at all. And it's not a one-off. The guidance suggests this continues. They're aiming for 37 to 39% in Q4. It's a clear sign that operational efficiencies are finally taking hold as their volume ramps up.
So this all feeds into what people call the operating leverage story. Can you walk us through what that means when you're literally building and launching rockets?
Sure. Operating leverage is basically the idea that once you cover your huge fixed costs like owning a launch complex or having hundreds of engineers on staff, every extra dollar you earn is more profitable than the last.
And we're seeing proof of that.
We are. The proof is in the earnings per share loss. In Q3, the EPS loss was only 3 cents. That was way better than consensus estimates.
So when you see revenue accelerating, margins expanding, and losses shrinking all at once,
you know you're seeing operating leverage start to work its magic.
Okay, that's the financial picture. But to understand why it's kicking in now, we have to look at the business model itself, that vertically integrated structure.
Right. The business really has two parts that feed each other: launch services and space systems. On the launch side, the Electron rocket is just a workhorse.
It's incredibly reliable.
It is. In 2025 alone, they're on track for 19 or more launches, and they've had a 100% success rate. That's better than last year's record.
And that kind of cadence builds a lot of trust.
Of course. They're handling really high-stakes missions for big international clients. We're talking about the JAXA Raise and Shine mission, and they have upcoming launches for the European Space Agency. That track record makes them the go-to for small launch.
So Electron is the proven workhorse, but I think the real financial engine, the part that drives future profit, is now the space systems segment. Why is that suddenly so important?
Because space systems is now the majority of Rocket Lab's revenue. And crucially, that segment has much higher gross margins than just launching rockets.
This is where the big government and defense contracts come in.
Exactly. The huge tailwind here is the Space Development Agency, the SDA prime contract.
Yeah, that contract is just transformative. It's a massive endorsement from the U.S. defense community. We're talking, what, an $816 million contract for 18 missile tracking satellites?
And that's just one piece. If you look at the total backlog from all SDA-related programs, it's now over $1.3 billion.
That's incredible visibility for future revenue. It's a buffer against market swings.
It is, and this gets back to your point about vertical integration. It's their real moat.
So is it just about reliability, or is there something more to it?
It's more. Their strength isn't just one thing. It's the whole package, the end-to-end solution. They can provide the key satellite parts like reaction wheels, star trackers, and then launch the final satellite on their own rocket.
Which creates very high switching costs.
Extremely high. If you're a defense agency and you depend on them for critical hardware, you're pretty much locked into using them for the launch too. They become this trusted, secure, one-stop shop.
And that structural advantage, being a full-stack space company, that leads us right to Neutron. This is their next big bet.
Neutron is everything. It's the vehicle designed to take them from a small lift player into the much more lucrative medium lift market.
It's designed to fill that gap, right, between small launchers and the huge rockets.
Exactly. It's optimized for deploying big satellite constellations, which is where most of the commercial money is headed. And crucially, It's designed to be reusable, and rapidly so.
We've had some really exciting updates on that front. Let's talk about the Hungry Hippo fairing. It's kind of a funny name, but the tech is a serious innovation.
It's a really elegant solution to a very complex problem. The Hungry Hippo is a design where the fairing, the nose cone, actually stays attached to the first stage when it returns.
So you don't have to fish it out of the ocean or reattach it?
Right. It massively simplifies refurbishment. And we know that this design is now fully qualified and has actually been shipped to the launch site in Virginia.
That's a huge de-risking milestone. It proves the concept works.
It's massive. It shows they're executing on a really complex, first-of-its-kind design. The target for the first launch is still set for 2026.
But, and this is a big but, we have to temper that excitement with the cost. Building a brand new reusable rocket. It's not cheap.
Not at all. It has required an enormous amount of capital. Their R&D spending is way up because of the Neutron program.
And that's why we're seeing negative EBIT margins, right? Around minus 40%.
That's it. It shows the company is in what you call heavy investment mode. They're pouring cash into future growth instead of short-term profits.
That's a high price to pay. Management says spending will peak soon, but how much of a financial buffer do they have to actually finish Neutron?
This is the key counter-argument to the cost concerns. Despite the spending, their liquidity is very strong. They're sitting on over $1 billion in cash and equivalents.
That gives them the runway they need to get it done.
It gives them the runway, even with potential minor delays. And remember, that runway is backed by that record $1.1 billion backlog.
Where 57% is expected to convert to revenue in the next year.
Exactly. So they have high certainty on near-term earnings, which gives them the capacity to fund the long-term plan.
Okay, that's reassuring. But we have to look at the bear case, the risks. And the first thing that jumps out is the valuation.
The valuation is definitely aggressive. The stock trades at a very high multiple to revenue, which makes it super sensitive to market swings. It has a beta of 2.20.
And for anyone who doesn't track this, a beta of 2.20 means if the S&P 500 moves 1%, Rocket Lab stock tends to move 2.2%.
Right. That's the price of admission for this kind of hyper-growth story.
And of course, the biggest risk is just execution.
Absolutely. The whole story hinges on the Neutron program. Any major delays past that 2026 target, or big cost overruns, would crush the stock. The entire long-term growth narrative is built on that vehicle working and working on time.
And then there's the insider selling. It's hard for retail investors to ignore when they see the CEO and a director selling hundreds of millions of dollars in stock.
You absolutely have to factor it in. In the short term, that kind of selling can act as a ceiling on the stock price, but you have to add context.
Which is?
Well, the stock is up over 100% this year alone. It's pretty standard for long-time insiders with huge positions to diversify and take some money off the table after a run like that. And they still hold substantial positions. It looks more like cashing in on gains than abandoning ship.
Okay, let's shift to market momentum, which, despite those risks, looks pretty bullish.
It does. The stock is trading in a really healthy pattern, well above its 50-day and 200-day moving averages. And those massive gains have pulled in a lot of institutional money.
So the big funds are buying in.
They are. Institutional ownership is up to around 71 or 72%. It suggests that, smart money is buying into this long-term story despite the short-term volatility.
And that's reflected in analyst price targets. A lot of firms have been raising them, with some calling for upside into the $75 to $90 range.
And that aggressive range is based on two things: the secure revenue from the SDA contracts and the growing clarity around the Neutron timeline and its massive potential market.
So if you're watching this company, what are the critical catalysts to look for over the next, say, 3 months?
Number one is the Q4 2025 earnings report. That'll be in early February 2026. The market needs to see that they hit their high revenue guidance and that margins kept expanding toward that 39% target.
So confirmation of the operating leverage thesis.
Exactly. Number two is just continued execution on Electron. That high cadence launch schedule has to continue, especially those missions for JXA and ESA in early 2026. It reinforces their reliability.
And number three has to be Neutron.
It's all about Neutron. Any updates on test milestones, engine testing, stage integration progress will be huge. Every successful update de-risks that 2026 target and gives the market more confidence to price in that future growth.
Okay, so let's tie this all together. What is the main takeaway here?
I think the main takeaway is that Rocket Lab is using its strong balance sheet and proven execution. 48% growth, 37% margins, record launches, to become the clear number 2 commercial space platform. The Neutron rocket is the key that could unlock truly transformative growth once it's operational.
So the story isn't just about launching rockets anymore. It's about owning the entire infrastructure stack. The real question you, as an investor, have to ask is whether the massive reward of capturing that medium lift market justifies the risk and the huge spending it's going to take to get Neutron flying.
If you want more in-depth analyses on companies driving innovation in the space sector, make sure to subscribe to Investing Talk podcast.